You ever see a huge company and just wonder, how on earth did they get started? Well, the secret ingredient almost every single time is money. And in this explainer, we're going to pull back the curtain on corporate finance. Basically, how businesses get the cash they need to launch, grow, and take over the world. So let's start right here. Every single great company you can think of started as just an idea in someone's head. But an idea, no matter how brilliant, needs fuel. And that fuel is capital. The big question is always, how do you get from that amazing vision to a real, functioning business when your wallet is empty? When you get right down to it, it really boils down to one massive choice. A founder has to pick between two main paths to get the cash they need. And trust me, this decision sets the entire course for the future of their company. Okay, so those two paths are equity and debt. Think of equity like this. You're selling a piece of your pie. You get cash right now, but in return, someone else owns a slice of your company. Debt, on the other hand, is a lot more straightforward. It's just a loan. You borrow cash, and you have to pay it back, usually with some interest. And this is the real gut check moment, the core trade-off. If you go with equity, you're giving up a piece of ownership, which also means giving up some control. Your new partners, your investors, they get a say. With debt, you keep 100% control. It's all yours. But, and it's a big but, you now have a legal duty to pay that money back, whether your business is booming or struggling. All right, so let's walk down that first path together. Let's say our founder decides to go the equity route. How exactly does a company sell off pieces of itself to get bigger? Well, it doesn't happen all at once. It's a journey. In the early days, a company might just use its own profits to grow, reinvesting whatever it makes right back into the business. But for that explosive growth, you need outside cash. That's when they might bring in partners, like venture capital firms. And then, for many, the ultimate goal is to go public, selling tiny pieces of the company or shares to anyone and everyone on a stock exchange. That's how you raise some serious capital. Now, this brings up a really important point, the difference between the primary and secondary markets. A company only gets cash when it sells brand new shares for the very first time. That happens on the primary market. When you hear about stock prices going up and down on the news, that's the secondary market. That's just investors trading existing shares back and forth. The company doesn't see a dime from that, but it's super important for figuring out what the company's shares are actually worth. Okay, hit rewind. Let's go back and explore that other path. What if our founder is thinking, no way am I giving up control of my baby? Well, that's when they turn to debt. They borrow money to build out their vision. And the world of debt has a whole toolkit. You've got your simple bank loans for everyday stuff. You've got long-term loans for big projects. A company can even get a mortgage to buy a building, just like you would for a house. And for the really big leagues, companies can issue corporate bonds, which are basically just IOUs that get traded among investors. Now, we've talked about equity and debt like they're two totally separate roads. But this is where finance gets kind of clever. What if you could find a way to mix them together and get the benefits of both? Well, you can. They're called hybrid instruments. The most famous one is a convertible bond. Here's how it works. At first, it's just a loan. An investor gives the company money, and the company pays them interest. Simple debt, right? But here's the magic trick. That investor has the option to later convert that loan into shares of the company. So it starts as a safe loan, but has the potential to become an exciting ownership stake. Of course, the world doesn't stand still, and finance is always evolving. Technology has completely changed the game, creating brand new ways for our founder to get that startup cash, often without ever stepping foot inside a traditional bank. First up, you've probably heard of this one, crowdfunding. The idea is brilliant in its simplicity. Instead of getting $1 million from one big investor, why not get $10 from 100,000 people? You go online, share your idea, and let the crowd chip in to make it a reality. And then there's peer-to-peer lending, or P2P. Think of these online platforms as matchmakers. They connect businesses that need a loan directly with regular people who have some extra cash to lend out. It completely cuts the bank out of the picture. So after exploring all of this, what's the verdict? Which path is the best? Well, the truth is, it depends. There is no single right answer. If you're a startup with a plan for explosive growth, equity often makes a ton of sense. But if you're a more mature business with steady, predictable income, debt can be a fantastic tool. It all comes down to the company's goals, its stage of life, and how much control the founder is willing to share. So there you have it, the basic toolkit of corporate finance.
from selling pieces of the company to borrowing money to all the new innovative tools in between. This is the engine that turns ideas into reality. Which kind of makes you think, right? If you had that next billion-dollar idea, which path would you take?